Hi everyone, this is Mitali Ingle from Sahyog College of Management Studies. I am a student of first year Business Administration. Today in this video we will discuss about mutual funds. So let's move on to our first topic. What is mutual fund? Mutual fund is money managing institution that pull money from people and reinvest it in capital market or stock market. We will understand this better by taking an example. If I have to travel from one distance to another, I have two options. First one is I have my own car, I can drive by my own, I can select my own route, I can decide where to stop, at what speed to drive and reach the destination. Second possibility is that if I am very keen to driving, I can hire a professional who will decide route for me, who will decide where to stop, at what speed to drive. This is the difference between stock market and mutual fund. In stock market, you have the power to take decisions for your investment. But in mutual fund, there is a fund manager who will take decisions for your investment. Fund manager will reinvest your investments in different securities and schemes of the mutual fund. But at the time of return, what happens is the total amount which you are going to receive, that includes your investment plus interest added on by the company. From this total amount, 1 to 3% of ratio will be deducted, which is known as expense ratio, and then the amount will be returned to you. This expense ratio is deducted for the working of mutual fund company. Let's move on to our next topic. What are the types of mutual funds? Earlier, what used to happen, as there are many more institutions of mutual fund, they used to tell people to invest in different mutual fund. So people used to get confused that where exactly to invest. So what Security and Exchange Board of India said that all mutual fund companies should have only 5 types of mutual fund. First is equity mutual fund. In this mutual fund, all your investments will be reinvested in stock market. So it is bit risky as it need to handle stock market fluctuations. Second type is debt mutual fund. In debt mutual fund, your investment are reinvested in different instruments of mutual fund company. So it is low risky as it has nothing to do with stock market. Third type is hybrid mutual fund. By the word hybrid, you can understand what is the meaning. Hybrid mutual fund is, in this type, some of your investment will be reinvested in equity mutual fund and some of your investment will be reinvested in debt mutual fund. Now, fourth type of mutual fund is solution oriented mutual fund. We will understand this by taking an example. If you have a child who is going to get married after 10 years, so you can invest money for his or her marriage. So what is solution oriented? That the things which are going to take place after a certain period of time, for that you already have plans, you already have investment. Second example we can take is your child's education. For your child's education, you can invest in mutual fund from the time of his or her birth, so that when he or she is 3 to 4 years old and going to get admission, at that time you can use this invested money. So you already have solution for the things which are going to take place after certain time. Last type of mutual fund is other funds, which includes index funds and nifty funds. Let's move on to our third topic, less explored type of mutual fund. In this, we are going to talk about a specific type of mutual fund which is beneficial if we invest in this type of mutual fund, that is liquid mutual fund. What is liquid mutual fund? In this type of mutual fund, your investment are reinvested in different instruments for the lock-in period of 91 days. Your assets are not being parked for more than 91 days. Suppose today my bank account is credited with 20,000 and I am confused at where to use this money. So I can invest it in liquid mutual fund, and even after 2 days after investing in liquid mutual fund, I get an idea that I have to use money for this purpose. I can get my money immediately back. Third point in liquid mutual fund, it is open-ended mutual fund. It comes under debt mutual fund, so it has nothing to do with stock market fluctuation. It is more useful for short-term investment. So what benefits it gives? That it has no lock-in period. It is debt mutual fund, so low risky. And third point is that it gives you more interest compared to your saving accounts and your FDs. Liquid mutual fund gives you 7% interest, which is more than your saving accounts and your fixed deposits. But there comes one point, is tax. I need to pay some tax to Government of India from my investment. What tax I need to pay? It depends on my salary. And from where this tax will be deducted? This tax will be deducted from the interest which that mutual fund company is giving me. From that amount, my tax will be deducted. If my salary is 2.5 lakh, then I need to pay 0% as a tax. If my salary is 5 lakh, I need to pay 5%. If my salary is between 5 to 10 lakhs, I need to pay 20%. And if my salary is more than 10 lakh, I need to pay 30% of my interest as a tax. This was for short-term investment. For long-term investment, we all need to pay 30% from our investment as a tax to Government of India. This was all about liquid mutual fund. Let's move on to our last topic, that is what are the risk factors and what precautions one should take to avoid those risk factors. First, check entry load and exit load for the mutual fund company. In many of the cases, entry load and exit load is 0. But in some cases, it is that if you step out of your investment before 7 days, then you will be charged some amount by that mutual fund company. Second is, you should always check lock-in period for your investment. Third point is, you should always check that your investment are reinvested in different instruments of mutual fund company and not only in one instrument. Your investment can be reinvested in the instruments like deposits, commercial bills, T-bills, etc. So, if your investment are only reinvested in one instrument, what can happen is, if your investment are reinvested with one of the instrument of one company and that company gets bankrupt, so what will happen? Your investments will be at high risk. So you should always check that your investment are reinvested in different instruments. So what precautions we should take? We should check entry and exit load. we should check lock-in period, and we should check that our investments are reinvested in different instruments of mutual fund. I hope you find this helpful. Thank you.